Good morning, everyone. So we are starting off with Fin4802 between now until 11 o'clock. But our class today is not going to be that long, mainly because it's the first class. It's in basic introduction, and we cover study unit 1 as well. So you'll see that for Fin4802, we have 19 study units. And our target is that by end of October, we should be done with the 19 study units as well. So we are still waiting to get more clarity regarding the exam timetable. But my assessment would be it's more practical and more feasible that would expect that the exams would be returned sometime in February next year, because I don't think they will change the timetable for the postgrad students as well. Probably for the undergrads, that's when they will be sitting in the October-November sitting. So our target is that we should be done with the curriculum by end of October, so that we have November, December, January, and February to do the revision as well. So we should be done with the 19 study units by end of October. And usually Fin4802, although it seems as if it's a lot of study units, you'll see that some of the classes will be able to cover even 2 study units in one class as well, mainly because some of the concepts, they are quite easy to understand as well. So it's easy to cover some of the material, more of the material, like some of the material, two chapters in one class as well. Now, of the 19 study units, please take note as well that there is going to be about, it's not necessarily the 19 study units translating to 19 chapters in the textbook, because there is 3 study units that you're going to be doing of the 19, which is readings that is basically extract from that the additional extract that have been provided by the author as well. So which means that of the 19 study units, you should also know that there are 3 readings, or which is 3 chapters that you're going to be doing based on the 3 additional readings, which are separate from the textbook as well. But once you are able to access the material on our portal, you will be able to access the 3 readings as well. Even if you go on your My Uni site, you should be able to access the 3 readings as well, because they are going to be they will be made available to you, because those 3 readings, they are going to be a bit separate from the textbook. And unfortunately, of those 3 readings, it's a read-only file, so which means that it's difficult to make notes on those. So you see that it's just a plain reading without any highlights or anything like that, mainly because it's a read-only file. So please make sure that you bear that in mind. So to ensure that you know exactly what you're supposed to be doing, I would strongly recommend that if you're going to be studying in advance, try as much as possible to stick to the study guide on exactly which study units you're going to be covering, because in the study units, that's when they will refer you to say, these are the chapters you're supposed to be covering for a particular study unit as well. So today we are going to be starting off with study unit 1. And also, please take note, I'll make sure that once please ensure that you communicate with us on the WhatsApp groups as well, or directly with communicate with me via WhatsApp, so that if you need to be able to create a user account on our portal, so that in case where you want to study in advance, you should be able to get at least a video of the next class in advance, so that if you want, after this class, if you say over Easter, you want to be able to cover the next study unit or the next class that we're going to be doing as well over Easter in advance by going through the video that we did in the previous year, you should be able to actually make sure that you create a user account on our portal, so that you're able to go through the videos. Because I would strongly recommend that if you go through the video of the next class that we're going to be doing in advance, you will see that it's very beneficial for you, because now when you attend the class, it's more like you're doing something for the second time as well. You will see that you better understand the concepts that are covered in class, which means that if you do that, it's going to be very easy for you now when you do revision, because most of the things you'd have actually understood them a lot better as well. So you won't struggle much when it comes to the revision period. So please try as much as possible to go through the at least a video in advance of the material that we're going to be covering in the next class as well. So for the textbook, I'm going to be sharing the electronic version of the textbook for the class, but you see that it will be slightly different from the textbook that is the latest version of the textbook that is prescribed. Here and there it's a bit different, but I believe I still remember exactly which sections I need to be adding on and what I need to leave out as well. So if it's a little bit different from what you're seeing in the textbook, please let me know, because but I think because we've done this a couple of times already, so which means that I think I remember exactly where the new version of the textbook is a little bit different from the electronic version that we have as well. So that's basically our plan for the year. So also, please ensure that you have the link for the timetable. So you should be having the link for the timetable, or at least have the screenshot for the timetable. And you'll also see that the timetable that we have rolled out already, it's covering the classes that are going to be having between now until end of October. And then the other classes that are going to be having in November, December, which is the revision timetable, we will roll it out sometime in September, somewhere there, or August, September, so that you're able to now know exactly what your timetable is going to be looking like for the revision period as well. We don't roll it out now because we need to make sure that it might have a bit of changes in case maybe we'll finish early, or we might not be able to finish a bit according to schedule. But we'll try, even if we are a bit behind schedule, we'll always make sure that we add 1 or 2 classes as well, so that whatever happens by end of October, we should be done with the curriculum as well. So before we start, are there any questions? So before we start, are there any questions? All right, so remember what I said, today's class, I don't think it's going to be that long, because we're just going to be going through study unit 1. It's just, the class is just for you guys to see how we conduct the classes, what the plan is, and what we need to be able to do, so that we're able to know exactly, so that in the next class we are going to be starting exactly at 8 o'clock, because we need to make sure that we cover as much material as possible. Our target is that in the next class we should be able to cover at least 2 chapters as well. That's our target. So we need to make sure that we start exactly at 8 o'clock as well. So today's class, we started a little bit later, mainly because people were now figuring out how to log in as well. I see someone sent through a question. INV4801, there was a bit of a mistake with the timetable. INV4801, it's supposed to start from 2 to 5 o'clock. So INV4801 is supposed to start from 2 to 5 o'clock. Then Fin4802 is starting from 8 to 11. Then from 11 to 2, it will be Fin4801. Then from 2 to 5, INV 4801 as well. So what I'm going to do is that I'm going to resend, I'm going to send the link for the timetable, but you'll see that the link that I'm going to be sending you now is the one with the updated timetable for 2021 as well. So you'll see I'm going to be sending you the links on the group. So if you're not yet on one of the groups, please make sure that you join one of the 2 groups that are available as well, so that you're able to get the link for the latest timetable. But if you go on the website, you should be able to get the timetable as well. It's there and it's updated.
Hi there. Sorry, I'm not sure if I can unmute and physically talk. Is that fine?
Yes, you can.
Okay, great. Just another question. I noticed that we only have classes once a month, and seeing that we're only covering study unit 1, would that be a sufficient amount of classes to cover all the units?
All right. Generally, your classes are for 3 hours, and generally your classes are supposed to be twice a month, but it's subjective to issues of holidays as well. So you see that if there's holidays, that's when you might have an issue where maybe you might end up having, I think it's April, where you might end up having maybe one class in a month or something like that. But generally, your classes are 2 classes per month. So you'll be having 2 classes per month, and each class is going to be 3 hours. So if you check on your timetable, you see that the ultimate aim is for you to have 2 classes a month, and each class would be for 3 hours as well.
Okay, brilliant. Thank you.
All right. Any other questions? Oh yeah, before I forget as well, when it comes to the assignments, we assist you and guide you to in doing the assignment as well. So what we'll do is that I think for Fin4802, you will be having about 2 assignments that you are going to be doing, and you are going to be doing those assignments together in class as well. So don't worry much about the assignments when it's about a bit like 2 weeks before, generally about 2 weeks before the due date of the assignment, we will be doing the assignments together in class as well. And I think for Fin4802, they usually just give out both assignments all at once, because some modules, they give you the assignments as and when they go. But I think for Fin4802, there'll be, what did they do last year? Yeah, I think they'll give you the assignments as and when you go as well. So if you haven't seen the assignment on your portal, don't stress much, because you'll see that when they feel that there's sufficient time for you, at least like a month before the due date of the assignment, it should be there on the portal. And what we usually do is that at least 2 weeks before the due date of the assignment, we will do the assignment together in class, so that we discuss, so that you're able to now know exactly what the concept is, how you're supposed to approach that assignment as well, so that you are able to get maximize as much marks as possible when it comes to the assignment. Because remember, your assignment is also going to be towards the final mark, your final mark as well. So you need to make sure that you maximize and get as high marks as possible when it comes to the assignments. So please don't worry much about the assignments. We will assist you and go through the assignments as quickly as possible. Have the assignments been, for Fin4802, has the lecturer sent out the assignment, is it?
He's already sent it out. I think it was 10 days ago when he sent it out.
All right. When is the first assignment due, by the way? I haven't seen it as yet.
2 seconds.
April or May?
Hello, the first assignment is due on the 21st of May.
On the 21st of May?
Yes.
So which means beginning of May, that's when we're going to be doing the first assignment. So beginning of May, that's when we're going to be doing the first assignment. But I'll communicate with you guys on the groups on exactly which day we're going to be doing the assignment on, or in which class we're going to be doing the assignment. So we'll be doing the assignments together, and we make sure that at least 2 weeks before the due date of the assignment, we do the assignment together in class, so that if you're still struggling, you'll be having enough time to actually consult and also ask more questions as well before you submit the assignment as well. So if you've done the assignment and you're still not sure about exactly how you've approached the assignment as well, I would strongly recommend that you communicate with me, so that I also assist you and explain a bit further on exactly to make sure that you maximize as much marks as possible when it comes to the assignments. But we'll try as much as possible to guide you and also send you the template, the Word document, which with the template of exactly how you're supposed to approach the assignment as well. Are there any other questions before we start? Any questions? All right, so let's start off with study unit 1. So let's look at study unit 1. And if you check on study unit 1, So looking at topic one looks at the international finance environment. And they say the aim of the topic, and they say this topic focuses on the context within which the financial managers of the multinational company make their decisions. So the discussions focus on key terminology, instruments, and institutions that are central to such decision-making as well. So you see that when it comes to topic one, the study units which are covered in topic one is these 5 study units. And of these 5 study units today, we're going to be looking at the overview of the multinational financial management, right? Now, when you look at the overview of the multinational financial management, in the textbook, just give me a second. In the textbook, on chapter 1, where we look at the multinational financial management and overview, on the first paragraph, under the learning objective, they say the specific objective of this chapter are to identify the main goal of the multinational company and potential conflicts with that goal, describe the key theories that seek to explain international business, and outline the common methods used to conduct international business as well. So you see that from these learning objectives, you see that this is where usually the lecturers usually pick out the concepts that they usually ask as questions in the exam as well. And please make sure that you take note of this as well. You see that chapter 1, there's quite a number of theory questions that they can ask from chapter 1 as well. So, but I'll be highlighting to you to say, please take note of this concept, please take note of that concept as well, so that you're able to know exactly what to expect as you are going to go into the exam. Because usually the things that I would have highlighted to say, please take note of them, please make sure that you take note of them, because those are potential theory questions that they can ask you going to the exam as well. So here they say on the first paragraph, the commonly stated goal of a firm is to maximize its value and that thereby maximize shareholders' wealth. So if you still remember from undergrad, from undergrad in the second year, where you started off with financial management, which those who did with UNISA, they did Fin 2601, you will see that the first chapter that they covered there in the foundational phase, they say, what is the goal of the firm? And the goal of the firm is to maximize shareholders' wealth. And how do you maximize shareholders' wealth? By making sure that you're able to maximize what? The value of the firm. So the goal of the firm, the goal of the financial manager is to maximize the shareholders' wealth, which also means that even if it's an international business, even if it's a multinational company, the goal is still the same, which is to maximize the shareholders' wealth by maximizing what? The value of the multinational company. And how do you maximize the value of the multinational company? Through maximizing what? The share price as well. So you see that these three, they are very much linked. So which means that whatever the financial decision that the financial manager is going to be making for the multinational company, they always have to make sure that they refer back to what is the goal of the firm, and the goal of the firm being to maximize the goal of the firm is to maximize shareholders' wealth by maximizing what? The share price. Because remember, this is how it's directly related with what? The wealth of the shareholders as well. So you will see that when it comes to a multinational company, it's just like a domestic company, where with a domestic company, it only has operations in the economy in which what it's operating in, right? But you see that with a multinational company, it's not going to be having operations in what? 2 or more countries as well, or economies. So when it's having operations in 2 or more economies, that's when we're now knowing that we're dealing with what? With a multinational company. So you see that when a company is having operations in 2 or more economies, there are so many things that you now have to bear in mind, which is a bit more complex, other than just a company that is what? dealing or having operations in the in its own domestic economy as well. So typical examples of multinational companies is where you see examples of South African companies that also have out other subsidiaries across Africa or across the world, like for example, the case of MTN. I like referring to the case of MTN mainly because there's usually controversies of exactly how they make their decisions on exactly where they would want to set up their subsidiaries and how they also conduct their businesses as well. But I'll be referring to them quite a lot when it comes to the issue of a multinational company, because I find it a little bit more interesting in a typical example of exactly the issues that are usually usually arise when it comes to the operations of a multinational company as well. So if you go back to the first paragraph, on line number 4 from bottom, they say, consequently, many firms have evolved into multinational corporations, which are defined as firms that engage in some form of international business. So their managers conduct international financial management, which involves international investing and financing decisions that are intended to enhance the value of the multinational company. So if they say multinational company or multinational corporation, it's basically one and the same thing as well. Then after this, if you go on to the next page, on the first paragraph, line number 4, they say, international financial management is important even to companies that have no international business, because these companies must recognize how their foreign competitors will be affected by movements in exchange rates, foreign interest rates, labor costs, and inflation. So such economic characteristics can affect the foreign competitors' cost of production and pricing policies. So because we're now living in a global economy, it means that even if you're only having operations where your company is just a domestic company, where it doesn't have any international operations, it's still going to be interested in exactly what is happening with across the world, mainly because with other multinational corporations as well, mainly because how they are affected is also going to affect what their level of competitiveness against you as well. Because remember now, it's now easier for customers or consumers to actually have more options. Because if you look at back in the days, a company that only had domestic operations, let's say, for example, a company that only had operations in its own town, they knew that no matter what happens, their customers are going to come and buy from them, right? And they were not worried about the competition coming from any other place, mainly because they knew that their customers back then, they didn't have much options other than buying from them as well, right? But what do we see now? Because of globalization and because of the growth of the internet as well, you see that the level of competitiveness is becoming more and more for companies, even if you're only having domestic operations, mainly because customers now can even just log in now. They can even go on the internet and go and take a lot. They can go on Amazon. They can order things online. They can even go and buy things from Alibaba as well, which basically means that customers are having more and more options on exactly where they can buy from as well. So because of this, it basically means that the level of competitiveness is also going to be high. So which means that even if you are only having domestic operations, it's very, very important for you to know exactly what is happening with your international competition. Because remember, you're not only competing with companies that are in South Africa. You should know that you're also competing with companies that are based in the US, companies that are based in China, companies that are based in Nigeria, companies that are based in Europe or across the world, mainly because customers now have an option of being able to buy from across the world as well. And because of the issue of globalization and faster movements in transportation as well, it basically means that customers can also buy and also get their goods quicker as well. So because of that, it basically means that the level of competitiveness now is increasing as well. So because of this, it means that even if you're only having domestic operations, you still have to know exactly what are the effects what are the issues that are going to be affecting a multinational company as well. Next, on the next subheading, we look at the goal of the multinational company. And here they say, on the first paragraph, they say, the focus of this text is on multinational corporations that are quoted in the world's stock exchanges. They will almost always have numerous wholly owned foreign subsidiaries. So the commonly accepted goal of such a multinational corporation is to maximize shareholders' wealth. So like what I was saying, whether it's only a company with domestic operations or it's a multinational corporation, the goal of the firm is still the same, and the goal of the firm being what? To maximize shareholders' wealth. And how do they maximize shareholders' wealth? By maximizing what? The value of the firm as well. Now, on the next section, we look at conflicts with the multinational corporation goal. And if you check on that paragraph on line number 5, they say, when a firm has only one owner who is also the sole manager, such a conflict of goals does not occur. However, when a corporation's shareholders differ from its managers, a conflict of goals can exist. So this conflict often is referred to as the agency problem. So you still remember from what you did at undergrad when you're looking at second year financial management, you will see that we looked at the forms of business organizations, where we say that when you look at the forms of business organizations, they are sole proprietorship, then they are partnerships, then they are also what? Companies as well, right? Which is basically the corporations that are dealing with there. And remember, in this case, the corporations are now coming in the form of what? Multinational corporations there as well. So what do we see? If the company is being, or is, if it's a sole proprietorship, it means the company, the owner of the business is the one who's what? Doing everything, right? And a typical example of a sole proprietorship that you see is, I like going back to the example of the lady selling magwinyas on the street. So you see that the lady selling magwinyas on the street, that lady, she's the supply manager, she's the finance manager, she's basically everything as well. So because of this, it basically means that there is no conflicting of goals, because everything is hinged on one individual. So there's no, that's why you see that there's no separation between the organization and the individual. So which means that because of this, and because there's no subordination, there's no subordinates, and there's very little issue of subordinates, and there's no the owner of the company is the one who's also heavily involved with the operations of the company as well. You see that the conflicts of the goals is not expected to be there, mainly because the owner of the business is the one who's basically running all the operations and making what? The decisions there. But now, when it comes to a company, this is where the agency problem basically arises, where now there's have to be an alignment between the goal of the interests of the owners of the business, which is the shareholders, and the interest of what? Of the management of the company as well. So you see that the moment there is the interest of the owners of the shareholders and the interest of the management are not in line, this is where the agency problem basically arises. But now, if it's a domestic company, the agency problem is lesser than when the agency problem that arises when it's what? Multinational corporation. Mainly because with the multinational corporation, what do you find? The shareholders are in one country and the management is another country. And you see that the shareholders, they have their own culture of how business should be done, and the management, because they're in another country with their own individual beliefs and belief system, and also culture as well. You see that how they are going to be running the business, the agency problems are also actually expected to be what? To be a lot higher. So picture how people do business in Japan compared to how people do business in like African countries or other countries as well. You see that when it comes to countries like Japan or even China as well, there is very little breaks. People are always working very, very long hours as well. But because here there's always going to be another holiday, strict adherence to the shifts and the different labor laws as well, you see that there's their chances of there being agency problems, they are expected to be quite high as well. Mainly because of of different clashes as well. So if you check on the next paragraph, they say the costs of ensuring that managers maximize shareholders' wealth are normally larger for multinational companies than for purely domestic firms for several reasons. First, multinational corporations with subsidiaries scattered around the world may experience larger agency problems because monitoring managers from distant subsidiaries in foreign countries is more difficult. So monitoring the managers from different countries there is more difficult. And remember now, it has been made a bit easier through the issue of the growth of the internet. Because now, what do we see? Managers can now easily monitor people from across the world because they can now use Zoom, or they can use Microsoft Teams and all those other technological advancements that they can use to actually bring people together. And back in the days, you would see that maybe if the parent company is in South Africa, you would find that some of the managers would literally have to fly to Nigeria, and from there spend a week or so, then they have to fly to another country as well, which basically means that monitoring those of the managers there was a bit more difficult than what it is now, although there's still issues when it comes to monitoring and the managers from different countries as well. Then on the next page, on line number 2, they say, second, foreign subsidiary managers raised in different cultures may treat the goals of the multinational company in a different way from the intended by the senior management, just like what I was discussing. Then third, the sheer size of the larger multinational company can also create communication problems, mainly because there is so many. They are now having an issue where there are just too many subsidiaries which are basically operating in different economies, and the companies now is going to be too big, which means that monitoring and managing such a company is usually difficult. Then, if you skip the next sentence, they say, fourth, the complexity of operations may result in decisions for foreign subsidiaries of the multinational company that are inconsistent with maximizing shareholders' wealth. So which means it's not, because the company is quite big, it basically means that making decisions for the multinational company is going to be very, very difficult, especially if the decisions have to be made by the from the head office. Because remember, if the head office where the parent company is situated is if they are going to be centralizing the decision-making system, it basically means that it's going to be very difficult now to make decisions, because they will just come up with one particular decision. But because different countries or different economies have different ways in which they're going to be operating, it basically means that some of the decisions now are not going to be necessarily suitable for the different economies in which the different subsidiaries are going to be operating in as well. So those are some of the conflicts that can also arise when it comes to the goal of the multinational company. Is there any question before we go on? Any questions? We look at impact of management control. So we look at the impact of management control and the different ways that the organizations can be structured as well. So here we say the magnitude of agency costs can vary with management style of the multinational company. A centralized management style, is illustrated in the top section of Exhibit 1.1, can reduce agency costs because it allows managers of the parent direct control of foreign subsidiaries and therefore reduce the power of subsidiary managers. However, the parent's managers may make poor decisions for the subsidiary if they are not as informed as subsidiary managers about local financial conditions. So if you check Exhibit 1.1, this is where you look at a centralized system. And with a centralized system, this is where we're basically saying that the different departments, they directly report to the financial managers who's located in the from the parent companies of the multinational company. So which means that all these departments, they are going to be directly reporting to the manager in the who's based in the what from the parent company as well, from the parent company of the multinational company. Which means in this case, if the company has two subsidiaries, it basically means that subsidiary A, the different departments are directly reporting to the manager here, and subsidiary B, the different departments are also directly reporting to the manager who's based in the parent company as well. So this is where we are having a centralized system. So what do we see? Now the problem, the advantage here is that there is quicker decision making, mainly because the information flow is going directly to the parent company. But at the same time, there is also an issue where the manager who's making decisions in the parent company, they might now make a blanket decision which might not necessarily suit these these different subsidiaries as well, because remember, they are also going to be affected by economic issues and economic factors which are not necessarily going to be the same. Then next, on the next paragraph, they say, alternatively, a multinational corporation can use a decentralized management style as illustrated in the bottom section of Exhibit 1.1. So this style is more likely to result in higher agency costs because subsidiary managers may make decisions that do not focus on maximizing the value of the entire multinational corporation. So which means that with the decentralized system, what do we see? The different departments are going to be reporting to the financial manager of that particular subsidiary. So which means that for the departments in subsidiary A, they report to their own manager, and the departments in B, they also report to their own manager. Then these managers are the ones who are not going to be reporting to the financial manager who's based in the parent company. So it's got its own advantages and disadvantages as well. So the advantage would be, in this case, the managers from the subsidiaries, they are more likely to make decisions which are suited to the conditions in which the subsidiary is also operating. But at the same time, the disadvantage would be the managers might end up making decisions which are not necessarily in the best interest of what multinational company. Remember, the interest of the multinational company there goes back to the goal of the multinational company, which is to maximize shareholders' wealth. Is there any questions regarding the centralized and decentralized system? All right. Then after this, on the next paragraph, they say, given the obvious trade-off between centralized and decentralized management styles, some multinational corporations attempt to achieve the advantages of both styles. So that is, they allow subsidiary managers to make the key decisions about their respective operations, but the parent's management monitors the decisions to ensure that they are in the best interest of the entire multinational corporations. So they normally, in practice, they will have more or less like a decentralized system, but it's more like a hybrid between a centralized and decentralized system, where it's a bit decentralized because they need to make sure that these managers are able to actually make their own decisions, and they are also able to grow and also grow the multinational company, the different subsidiaries as well. But at the same time, the parent company would now have monitor to see exactly what is the progress. And remember, now these days it's easier to monitor because of the growth in the better communication systems as well. So next, we look at how the internet facilitates management control. Like what I was saying, because of the growth in the internet and the easier access to the internet and the faster speeds that we're seeing when it comes to the internet communication as well, you see that multinational companies, they usually have are able to actually have meetings where, for example, they'll be having a Zoom meeting with people from different countries and different time zones as well, which means that they will now have to integrated time that they will say that is best suited to everyone, and then they will now be having what regular meetings with the different managers, and that way it basically means that the monitoring and controlling of the different subsidiaries is going to be made easier, mainly because they are able to actually keep constant communication and getting more regular feedbacks from the different managers as well. The impact of corporate control, we're not going to be doing it because I said I put a note there because it's not in the new textbook. So we are not going to be looking at that. Next, we look at the constraints interfering with the multinational company's goals. So the constraints interfering with the multinational company's goal. And here they say, when financial managers of multinational companies attempt to maximize their firm value, they are confronted with various constraints that can be classified as environmental, regulatory, or ethical in nature. And when you look at the environmental constraints, they say each country enforces its own environmental constraints. So the building codes, disposal of production waste material, and pollution controls are examples of restrictions that force subsidiaries to incur additional costs. So the threat by a multinational company to locate elsewhere in the face of overly harsh local environmental laws acts as a significant restraint to countries wishing to pursue a strong environmental policy. So you find that because if you look at what was happening previously, maybe in the before the modernization of the economies as well, you see that many multinational companies, they were having a situation where many countries were and many governments were having a situation where the multinational companies would come in and just do business and just dump things, and then when they've made a lot of money, they'll just go. But now they now are going to be forced to say, for example, if it's mining, they have to actually set aside a reserve fund to actually to actually rehabilitate the environment after they are done with their operations. So we know that, remember, the goal of the firm is to maximize shareholders' wealth. So how do you maximize shareholders' wealth? It means the multinational company, for them to be able to maximize the shareholders' wealth, ideally they want to minimize the costs. And how do they minimize the costs? It basically means that when they now have to actually rehabilitate the land, for example, if it comes to mining, it basically means that it's going to be becoming what? A cost to them as well. So which means that now there has to be a balance between the costs that they have to actually set aside to actually rehabilitate the land. And you see that in some cases, you start seeing multinational companies actually moving away from certain countries as well because of the environmental constraints that they have to be, they are going to be enforced to actually rehabilitate the environment in which they are also operating from as well. The next one is regulatory constraints. And here they say each country also enforces its own regulatory constraints pertaining to taxes, currency convertibility, earnings remittance, employee rights, and other policies that can affect cash flow of the subsidiary established there. So this is where you look at the different regulatory constraints in which the multinational company operates in. And if you still remember, I think it was a couple of years back where MTN was in trouble in Nigeria, where they were accused of remitting profits and transgressing on the flow of funds between one country, on the flow of funds between when they were remitting the profits to the parent company to South Africa as well. And because of this, the Nigerian government ended up fining MTN, and even Standard Bank, which was the bank that was being used, that they were operating in, that they were using to actually do the remittance of the profits as well, was having issues with the government as well. So those are some of the regulatory concerns that one has to, a multinational company has to take into account. Because remember, in most cases, you would find that the reason why they would be worried about the regulated constraints, like for example, the flow, the remittance of profits, is mainly because the parent company would have spent money to invest in the subsidiary, with the hope that they're going to be able to get what their money, so that they're also able to keep their own operations and use that money what to keep themselves afloat as well. Which means that if they are going to be harsher regulatory constraints, it basically means that it's going to be very difficult for now the parent company to be able to get that money, so that they're able to actually what sustain their own operations as well. So which means that those are some of the things that they have to what take into account on exactly how they would make decisions to say, should we invest in a particular country or not invest in a particular country, depending on exactly what the constraints are as well. And some of the issues that also arises is basically where the cost of labor and also unionization, where the multinational company may also seek to invest in a country where there's lesser regulatory issues when it comes to issues of like, for example, minimum wage and so forth as well. So that this is why you would see many American companies opening up in China, where the labor laws are lesser strict than the other developed countries as well. So, like, for example, if you look at Nike and Adidas and all those other companies as well. So they also have to take into account the regulatory constraints in the country in which they are considering operating in as well. The other issue, if you go to after this example, if you go to the next paragraph, they also look at ethical constraints, where they say there is no consensus standard of business conduct that applies to all countries. So a business practice that is perceived to be unethical in one country may be totally ethical in another. So, for example, a multinational company, multinational corporations are well aware that certain business practices are accepted in some less developed countries. In some less developed countries would be illegal in their home country. So bribes to governments in order to receive special tax breaks or other favors are common in some countries. So going back to the same issue of MTN as well, you would see where they were in trouble a couple of years ago as well, where they were bidding for a telecom contract in Iran, where a American-based company ended up taking MTN to court as well because of that, mainly because they were being accused of bribing some of the officials to actually be able to win the contract as well. So you see that because the company is operating in different environments and different places that they're going to be operating, countries that they're going to be operating in as well, they also have to take into account ethical constraints. And usually, although different economies have different ethical issues, you would find that nowadays there are now professional bodies that try to standardize the code of conduct when it comes to the issues of ethics. Like, for example, you would find that many people in management positions for these multinational companies, they usually belong to a particular professional body. And most professional bodies, they also have code of conduct when it comes to ethical constraints. And usually, when it comes to the code of conduct, when it comes to ethical constraints, if they belong to a particular professional body, they have to adhere to the stricter of either the code of conduct of the professional body or the the code of conduct when it comes to the country in which they're going to be operating in as well. So you see that because many of the management, the individuals who are in management positions of the multinational companies belonging to professional bodies, this is how they are now able to deal with issues of ethical constraints when it comes to multinational corporations as well, mainly because the professional bodies usually have their own code of ethics, and all the members of that professional body are expected to adhere to a certain code of ethics as well. That's why you see that even if you look at the whole state capture inquiry as well, you see that some of the people who, like, for example, who are belonging to the chartered accountants, they are also in trouble with their own professional body when it comes to the expected code of ethics as well. And there's also going to be ramifications on them as well. So which means that this is how the issue of ethical constraints is able to be dealt with when it comes to multinational companies as well. So on the next paragraph, they say they look at managing within the constraints, and here they say some multinational companies have made the costly choice to refrain from business practices that are legal in certain foreign countries but not legal in their home country. So thus they follow a worldwide code of ethics. So they may enhance their worldwide credibility, which can increase global demand for their products as well. So which means they are basically saying that when it comes to these constraints as well, it basically means that they have to, at the end of the day, there's always going to be a link between adhering to these constraints, and the goal of the firm. Because if the management does not adhere to these constraints that they're going to be facing as well, it's going to be very difficult for them to now do business with other companies, mainly because because of the reputation of the multinational company as well. Because if the multinational company has a bad reputation, it basically means that there's going to be difficulties in actually getting more business, like what you see when it comes to the issues where KPMG was in a lot of trouble, and they are now trying to revive their name, and also putting in place other people to try to revive their name as well. Mainly because the moment they don't adhere to these constraints, there is also going to be bad reputation, and other people are not going to not want to do business with them as well. So there's always, and if they don't do business with them, it means there's no longer any revenue coming in, and if there's no revenue coming in, there's no profitability in the short run, and in the long run, there's lack of they are not going to be able to maximize the value of the firm as well. So there's always going to be a link between these constraints and the goal of the firm. Are there any questions when it comes to the constraints before we go on to the theories? Are there any questions? We look at the theories of international business. So we look at the theories of international business. And another section, they say, theories in this area seek to explain the level of and nature of international business. So there are two broad categories: economic and business related theories. So economic theories address the problem at national level, looking at how countries can increase their overall level of wealth through international trade. And then if you go to on the same paragraph, on line number 3 from bottom, they say business theories are based on observation. They seek to find common patterns of development of international business and model these patterns into coherent explanation. So when you look at economic theories, they say theory of absolute and comparative advantage. So the one economic theory that you can look at is the theory of absolute and comparative advantage. And here they say the theory of absolute advantage was first formally stated by Adam Smith and conforms to what most non-specialists would advance as an explanation and justification for international trade. So suppose that country A is more efficient in producing food and country B is more efficient in producing machinery in a two-country world. The world production of food and machinery can be increased by specialization. So country A should produce more food than it needs at the expense of some machinery production, and country B should produce more machinery than it needs at the expense of some food production. So country A can then trade some of its surplus food for some of country B's surplus machinery. So the important point here is that through better use of resources by means of specialization, the world totals of food and machinery are now higher than before specialization. So when it comes to the theory of absolute advantage, you're basically saying that the country would produce more of a good that they are good at producing, mainly because they are now, if they produce excess, they are now going to use that excess amount to actually trade for the other good with the other country with the other countries that is better at producing that good that they also need as well. So this is basically a typical example of the theory of absolute advantage. On the next paragraph, they also look at the theory of comparative advantage, and here they say the economist David Ricardo extended this analysis to the law of comparative advantage. He asked the equivalent question to, what if A were less efficient at producing food as well as less efficient at producing machinery? So he showed that if A produced more of the product at which it was comparatively less inefficient, it was still possible for a world production level of food and machinery to increase, and both parties could still benefit through international trade. So suppose in this example that country B is developed its that country B developed its food production and became slightly more efficient than country A and remained much more efficient in producing machinery. There would still be benefits for both parties if A specialized more in food and B more in what? In machinery. So they're basically saying that even if when you look at the law of comparative advantage, they're basically saying that even if B is slightly more efficient in producing both goods and machinery, and if B is more efficient in producing both goods and machinery, and A is a bit more efficient, is not as efficient, but is better at producing food than producing what? Machinery. There would still be the benefits in A being able to actually what? Produce more goods and also produce more goods and then trade those goods with what? With country B as well. So that this is basically where the law of comparative advantage comes in. So this is where the law of comparative advantage basically comes in. So they are saying with the comparative advantage, even if country A is not as good at producing what? Both good food and machinery, but they are better at producing food than machinery, there is still a benefit that can be derived from A producing what? More food, for excess food, and the excess food then trade the food to what? With B as well. So is there any question when it comes to the theory of absolute and comparative advantage? Any question?
Just a quick question, sir. So it still comes down to, although they are more inefficient, they still specialize in producing one product. Emphasis on specialization, because that's the one word I didn't hear you mention in your last sentence.
Yes, so which means they are basically saying that there is a benefit that can be derived from A specializing more in producing what? In producing food, even though B is better at both as well. Mainly because if they are going to be specializing more in producing food, they can, whenever they have excess food, they can now use that excess to actually what? Trade for machinery with what? With country B as well. So there is still some benefit that can be derived. Although you see that economically speaking, they won't have that much upper hand than what? When it comes to the trading as well. Because if you look at it, they won't have that much upper hand when it comes to the trading, but there is still some benefit that can be what? That can be derived from being able to trade the excess food with what? With country B as well.
Thank you.
All right. Any other questions? The next economic theory is the imperfect markets theory. And here they say, countries differ with respect to resources available for production of goods. Yet, even with such differences, the volume of international business would be limited if all resources could be easily transferred among countries. So if markets were perfect, production, the factors of production would be mobile and freely transferable. The unrestricted mobility of factors would create equality in costs and returns and remove the comparative cost advantage. However, the real world suffers from imperfect market conditions where factors of production are somewhat immobile. So like for example, people are not willing to move. So here they're saying, if you check on the last sentence of that paragraph, they say, overall, wealth can be increased as imperfect markets provide an incentive for firms to seek out foreign opportunities and produce wealth that otherwise would not have been created. So here, when you look at the imperfect markets theory, they are acknowledging that in the perfect examples, in the perfect in a perfect world, or in a perfect world, it would be easy for the factors of production to be made available, right? And if the factors of production are made available to those who need them, it means that they are able to maximize the value of the firm. But now the problem is that we in the real world, the factors of production are not easily accessible. Like, for example, when it comes to labor, the labor is not easy to move. Like, for example, if someone is staying in Cape Town and someone let's say, for example, if someone has been staying in Gauteng for a big chunk of their life, and they have a family and their children are going to school, they have a house that they're also paying as well. It's difficult now to say, if the company needs their skills that is in Cape Town, for them to just easily move to Cape Town. So even in a perfect world, they'll just take off and go to Cape Town where their skills are needed most. But what do we see? In a real world, or in an imperfect market, it's not easy for that factor of production to actually make that decision to actually move to Cape Town where their skill is needed there, mainly because there are other things that are also going to be affecting the mobility of that skill to where it's going to be needed as well. So this is where they are discussing this is where the whole imperfect markets theory is based on. It basically means that there is because markets are imperfect, it means that the factors of production are not easily moved to where they are needed. So which means that if there's going to be an incentive for the factors of production to actually be able to be easily to move to where they are needed, that's when now there's going to be there's going to be the value of the firm is going to be is going to be able to be maximized or created as well. So this is where, for example, when you look at companies, this is where they would say, okay, fine, if you're going to be moving, we are going to incentivize you, we're going to pay you a higher salary, we're also going to help you with the cost of moving to Cape Town. And that way, it basically means that there's an incentive now for this party with these skills that the company is going to be needing to actually to move to Cape Town, because they're now being incentivized to actually to be able to now move their skills to where they are needed by the company. Because remember, the company also needs this skill so that they're able to actually have the perfect skill that they need for them to be able to maximize the revenue. And if they maximize the revenue, they're going to be able to maximize the profitability in the short run, and in the long run, they're able to maximize the value of the firm as well, which is basically the goal of the firm. Any question before we go on to the business theories? Now, when it comes to the business theories, the first business theory is product cycle theory. And with the product cycle theory, they say one of the more popular explanations as to why firms evolve into multinational corporations is the product cycle theory. According to this theory, firms first become established in the home market to meet local demand. A lack of information and a lack of resources creates a preference for single market development. Where the product is successful, the firm will experience foreign demand for its products from exporters, foreign companies, or even via the internet from foreign customers. So as time passes, the firm may feel the only way to retain its advantage over competition in foreign countries is to produce the product in foreign markets, thereby reducing its transportation costs. So here we're saying, when it comes to the product life cycle theory, initially the firm produces the goods or service to meet the local demand. Then after meeting the local demand, so this is basically what is explained in Exhibit 1.2, right? So first, the company is aiming to meet the local demand, but now because of the popularity of the goods or service that they are producing there, they now start exporting the product to meet the foreign demand. So they will now be exporting the product to meet the foreign demand, because now this is basically where the customers from other countries, they place an order, and then the company now would now be transporting those goods either through using the different trucks or using the different transportation systems as well. Then over time they realize that, you know what, our transportation cost is becoming high, because every time an order is placed, we're going to be incurring a cost to actually transport that good. So which means that the bigger the demand, the more the incentive it is for the company now to actually set up its subsidiary where the demand of the good is high enough. So which means that when the demand of the good is high enough, this is basically where you see that the level of foreign sales are now quite high or significant. So this is where the international market stabilizes, production located internationally to exploit cost savings. So this is where the company is now going to set up its subsidiary there, so that then they know that they are no longer incurring transportation costs, because remember, the goods are now going to be made available locally where the company is where the subsidiary is now going to be set up as well. So that way, it basically means that they're able to lower their cost of transportation, which can end up being significant, because remember, every time a unit of good is needed, they have to export it. But now, because the goods are now available to the subsidiaries where the demand is high there, it basically means that they're able to actually cut down on the transportation cost, which ends up maximizing the value of the firm. Because remember, take note, the goal of the firm is to maximize shareholders' wealth. And how do you maximize shareholders' wealth? By minimizing the costs. So which means that's why you see that companies, they always try as much as possible to minimize their costs, because they know that if they're able to minimize their costs, they're able to maximize their profitability in the short run, and in the long run, they're able to maximize the value of the firm as well. So this is where the product cycle theory comes in. The next one, or the next paragraph, is the global strategies, where they say international business is seen as a product of global strategies being pursued by multinational corporations. So the large investments required for medical research can only be recouped by patenting and marketing the products worldwide. So which means when it comes to global strategies, they're basically saying that they know that the moment they patent their products and make them available on a global scale, it basically means that the demand is also going to be on a global scale, other than meeting only the local demand. Because remember, the global demand is going to be able to actually it's going to be exponentially big than the local demand, which basically means that if the global demand is exponentially big, it means that the revenue that they're expecting to generate today is also going to be exponentially big, which means that the profitability that they're also going to be able to produce there is also going to be exponentially big. And also in the long run, they're able to maximize the value of the firm as well. That's why you see that when it comes to global strategies, this is why you see that, for example, if you look at the issue of the vaccinations, this is why there's always going to be a friction between the first world country and the third world countries as well, mainly because in the developing countries, they don't have that much resources for them to be able to actually produce the vaccines. But now, the companies that are in the first world countries, they have the resources to be able to produce the vaccines. And what do you see? Now there's a problem where they are now, because the demand is high and they've patented their product there, the access of the vaccines is now becoming very difficult for the developing countries than the first world countries, especially when you look at the issue of Africa, where we were involved in the trials when it comes to the vaccines, but at the end of the day, because of the issues of patenting of the product, it basically means that the companies that are based in the developed countries are the ones who are now going to be in control of exactly how much should be distributed where. And because of this, it basically means that they know that for them to be, because they've spent a lot of money to actually develop the vaccines, they need to make sure that whatever happens, they are also able to recoup that money and maximize the value of the firm as well. That's why you see that there's always going to be friction between the access of the vaccines between the developed nations and the developing countries as well. Is there any question when it comes to business theories? So please make sure that you take note of the theories of international business. So please make sure that you take note of the theories of international business, be it economic or business theories, because you might be asked to explain those theories as well. So it's a potential theory question that you can be asked in the exam. Next, we need to look at the international business methods. And this is also another question that I've seen a couple of times being asked in the exams as well. And when it comes to international business methods, so when it comes to the international business methods, so when you look at international business methods, they say firms use several methods to conduct international business. So they say firms use several methods to conduct international business. The most common methods are international trade, licensing, franchising, joint ventures, acquisition of existing operations, establishing of new foreign subsidiaries, and also there's another one, which is the special purpose vehicle as well, that we're going to be discussing. And the first one that we're going to be looking at here is international trade. And when you look at international trade, the main idea here is looking at importing and exporting activity of the company. So if the moment the company is involved in importing and exporting of goods, this basically means that they are now involved in what? International trade. So which means that this is where the company is involved in importing and exporting of goods. So this is what they mean by international trade. So so here they say they also look at how the internet facilitates the international trade, mainly like what I was explaining, where you find that the companies, and because of the internet, it basically means that it's easy for customers across the world to actually buy the goods that they need as well. Like for example, where they look at Amazon and all, and locally we look at Takealot as well, where customers are able to buy those goods, and which means that in this case they're going to be exporting the goods to the customers, and if they need any goods that they're going to be in need of, there's also going to be issues of importing of those goods as well. Then process the goods and sell those goods to the end users as well. And this is where you also find a lot of issues where I forgot the term that they use, where over the internet a company can even set up operations over the internet and buy the goods from China and also sell and market those goods to the end user, where the stock does not even need to go to the company itself. They're just going to be moving the goods between the producer, which is the seller in China, and sending them directly to the customers over the internet without having to even hold any stock as well. So which means that the progressive of the internet in itself also allows a lot of growth when it comes to importing and exporting of goods as well.
I think you call that drop shipping.
Oh yeah, drop shipping. I was forgetting the term. Yes, it's drop shipping as well. So you see that because of the progressiveness of the internet as well, there's a lot of movements when it comes to international trade. Like for example, through drop shipping, where the stock does not even go to the company itself. Over the internet, there's just going to be movements of those goods as well. Next, we look at licensing, and with licensing, they say involves selling copyrights, patents, trademarks, and trade names or legal rights in exchange for fees known as royalties. Then if you go to line number 5, they say licensing allows firms to use their technology in foreign markets without a major investment in foreign countries, and without the transportation cost that results from exporting as well. So which means that when it comes to licensing here, they're basically saying that this is where the licensing of their goods basically, so which means that they are basically selling the rights to another company, where they are now going to be they are going to be using that right now to actually sell the goods and services as well. So which means that it allows which means that the issue of licensing now, it basically means that because the company that is going to be holding the license is now going to be given the right to actually to do the operations. So because of this, it basically means that it allows a lot of international trade as well. Then the next one is franchising. And with franchising, they say under a franchising agreement, the franchisor provides a specialized sales or service strategy, support assistance, and possibly an initial investment in the franchise in exchange for periodic fees. Like, for example, you look at McDonald's or Pizza Hut and all these other companies as well, where they establish the franchise, and the company that is selling the franchise is the one that's going to help set up the operations, and then they are now going to be able to actually pay those periodic fees as well. So you see that this also allows a lot of growth when it comes to international trade as well. The next one is joint ventures, where they say a joint venture is a venture that is owned and operated by two or more firms as well, right? So which means that when it comes to joint ventures, this is where, for example, you will see that in some countries, they have laws which they need the locals to be involved in any operations that are going to be done by the multinational company as well. So that way it would mean that the multinational company would now have to go into a joint venture with the local company so that they would actually operate in certain countries as well. So which means that this is where the venture that the operation that they're going to be doing in that particular country is now going to be owned by by the two firms, which is the multinational corporation and also the local company that is going to be involved in the operation as well. So this is where they can form a joint venture. Then there's also acquisition of existing operations. And when it comes to acquisition of existing operations, this is where firms frequently acquire other firms in foreign countries as a means of penetrating foreign markets. Then if you go to the next, if you go after the example that they give us, they're on line number 3, they say the risk is that too much has been paid for the too much has been paid for the acquisition. Also, that there is unforeseen problems with the acquired company. So it has to be remembered that the sellers of the company have a thorough knowledge of the business, and the price at which they are selling is presumably higher than what they are estimating. So here they're saying that when it comes to acquisition of existing operations, this is where the multinational company, they're saying that for them to be able to grow, they are basically going to be buying other companies or an existing company in the country where they want to operate. So here it comes with its own advantages and disadvantages. So the advantage there is that the company is already having a customer base, it's already having operations, it's already having infrastructure. So which means that starting operations becomes it becomes easier. But now the disadvantage now is that because they are acquiring an existing operation, now knowing exactly what the fair price should be that they're going to be paying to the sellers of the operation that they are trying to be that they're going to be buying is going to be very difficult, because sometimes they might end up paying too much than what the operation is worth. And that way it basically means that it becomes disadvantageous to the acquiring company as well. And also the other issue would be they don't know exactly what they're buying into, and why really the existing owners are actually selling their existing operation as well. So which means that they might end up buying this operation only to realize that there are so many other issues that are going to end up hindering them being able to actually make the operation profitable as well. So because of this, it basically means that when it comes to a multinational company, they're going to be considering acquisition of existing operations. They also have to bear in mind and do a thorough research to understand exactly what are the advantages and disadvantages, and what are the issues that, and also what they're going to be facing whenever they're going to be acquiring this existing operation as well. Next, we look at establishing new foreign subsidiaries. And here they say, firms can also operate foreign markets by establishing new operations in foreign countries to produce and sell their products. So like a foreign acquisition, this method requires large investments. So which means that just like a foreign acquisition where the multinational company is buying an existing operation, even if they decide to acquire or establish a new foreign subsidiary as well, there's going to be a huge capital outlay, because remember, they are basically buying out everything that they are going to be establishing everything that all the operations, they are basically going to be establishing the operation from scratch. So which means that they have to now establish to see exactly where are we going to be locating, what infrastructure are we going to be needing to establish there, how are we going to be able to get the labor and all the other factors of production to be able to start the operations as well. Which means that because of this, there's going to be a large investment that is needed to be actually to be made, so that they are able to establish the foreign subsidiary as well. And this also comes with its own advantages and disadvantages. And the advantage would be when it comes to establishing their own new foreign subsidiaries, they're able to actually create their own identity and also maintain their own identity as well. But at the same time, the disadvantage here is that they are having to now start when they're starting operations from scratch. It basically means that they are going to be having to spend a lot more money in actually marketing and making their company being known out there as well, especially if it's a company that is not known across in the economy in which they're considering operating as well. Which means that this also ends up increasing the amount of investment that they have to make when it comes to establishing new foreign subsidiary as well. The other method that is also mentioned in the new textbook is where another method is establishing a special purpose vehicle. And when you look at a special purpose vehicle, this is basically this is a subsidiary company that is formed to undertake specific business purpose or activity. So the special purpose vehicle are commonly utilized in certain structured finance applications such as asset securitization, joint ventures, property deals, or isolate parent company assets, operations, or risks. So which means in this case, when it comes to special purpose vehicle, it can be established for different purposes, depending on exactly what the parent company is trying to do as well or achieve. Because sometimes they might realize that, we don't want the risk that is going to be emanating from the operations that we're going to be doing, or whatever we're going to be doing in the foreign country, to be actually come back and actually being riskier to the parent company as well. So what do? They create a special purpose vehicle which is basically going to be operating independently of the parent company, and that way it basically means that it's going to end up insulating the risk to the parent company as well. And sometimes companies can also create a special purpose vehicle. For example, they know that they are being owed a certain amount of money from customers in another country, but now they want to be able to access the money sooner than getting that money when the customers pay. So they can create a special purpose vehicle where, with a special purpose vehicle, the special purpose vehicle can now be established in the foreign country, and also now its assets, or the assets of the special purpose vehicle, is going to be the amounts of that is going to be owed by the debtors, and they can now be able to actually use the amounts that is being owed by the debtors there as security to get financing from the local financial institutions there for the operations of the company to continue operating there as well. So there are different reasons why a company would actually end up establishing a special purpose vehicle. So is there any question when it comes to international business for a multinational company? Is there any question? International opportunities, we're not going to be covering it because it's not in the new textbook. So this section is not relevant. Next, we are going to look at exposure to international risk. So next, we're going to look at exposure to international risks. And when you look at exposure to international risk, they say, although international business can reduce a multinational company's exposure to its home country's economic conditions, It usually increases a multinational company's exposure to 1, exchange rate movement, and 2, foreign economic conditions, and 3, political risk. So looking at these exposures, the first exposure that we're going to be looking at there is the exposure to international rate movements. So one example or one exposure that they're discussing here is the exposure to international exchange rate movements, where the movements in exchange rate can end up affecting the value of their investment as well. A typical example would be when you look at the case of Barclays Bank, where, remember Barclays Bank, they established their operations in South Africa. I think it was around 2005, 2006, somewhere there. And you see that, let's say, for example, it was 2005, and you see that the exchange rate between the rand to the US dollar was around 6 rand was equal to $1 US, right? So around 2005, the exchange was around, let's say, for example, it was around 6 rand was equal to $1 US, right? Then now, around 2015, 2016, somewhere there, let's say it's 2015, 10 years later, they started now considering what disinvestment from South Africa. And around that time, it was around 15 rand was equal to 1, let's say it was around 15 rand was equal to $1 US. Now we want to see exactly how does exchange rate ends up affecting the, how does exchange rate end up affecting what your the multinational company as well, right? So let's say, for example, they started off by investing 100,000 US dollars, right? They started off by investing 100,000 US dollars. It would mean in 2005, that amount would now have converted to, if it was 100,000 US dollars, it would mean that their investment in rand would have been an equivalent amount of about 600,000 rand. So it would be an equivalent amount of 600,000 rand. Now, if the investment is an equivalent amount of 600,000 rand, they invest this money in South Africa, right? Now, if we exclude the effect of how much they are going to be getting as earnings or as returns as well, we now need to find out exactly in 2015 when they decide to disinvest. Remember, they have now their investment that they made there is 600,000, is the equivalent amount of 600,000 rand there, right? Now we need to find out exactly how much this 600,000 rand that they've made in South Africa. Now, when they want to disinvest this money, when we exclude the earnings that they would have made, how much this money would be worth in US dollars. It would mean we are now going to be saying this 600,000 rand, we would now convert it to US dollars. Would have now said 600,000 divided by 15. And if you say 600,000 divided by 15, how much would be the equivalent amount in US dollars there? How much would be the equivalent amount? How much would be the equivalent amount?
40,000.
40,000. So do you see that because of the movement in exchange rates, their initial $100,000 investment has actually gone down to an amount of $40,000. So the initial investment of $100,000 would have gone down in value to $40,000 because of what? Movements in exchange rate. So this is basically what they mean when they look at exposure to what? Exchange rate movement, because the weakening of the currency in which you are investing would now end up what? Affecting the value of the investment. And in this case, it's negatively affecting the value of the investment. So do you see how the exposure to exchange rate movements would actually come about when it comes to a multinational company? Any questions? We look at exposure to foreign economies. So we look at exposure to foreign economies, and here they say when multinational corporations enter foreign markets to sell products, the demand for these products is dependent on the economic conditions in those markets. So which means when it comes to exposure to foreign economies there, it basically means that the performance of the subsidiaries there, where they're going to be selling their product, also is also going to be dependent on exactly how those economies are performing. Because if they enter into the economy and if they enter into a particular country and the economy is going through a recessionary phase, it would also mean that their revenue is also going to be negatively affected by what the economic cycle in which the country is experiencing as well. So which means that at the end of the day, it would now end up having a situation where they would now having a situation where the demand of their product there is going to be very low, which means that now the parent company now, they have to be having to now decide to say, should we spend more money to actually resuscitate or to sustain the subsidiary, or should we consider withdrawing the operations from the foreign economy as well. So which means that the economic conditions in which they are considering investing in is also very important, which means that can also negatively affect the performance of the multinational company as well. The next one would be exposure to political risk. And here they say when multinational corporations establish subsidiaries in foreign countries, they become exposed to political risk, which arises because the host government or the public may take actions that affect the multinational corporation cash flows. The multinational cash flows as well. So here they say the political risk is often viewed as subset of country risk. So which means a typical example of political risk, if you check on the next page or second paragraph, they say terrorism and war, where they say one form of exposure to political risk is terrorism. So a terrorist attack can affect the firm's operations or its employees. So this is another issue where a multinational corporation, they have to take into account the political risk. Like, for example, if you look at the case of MTN, they also had to take into account exactly what their risks are, what their political risk exposure was before they even invested in a country like Nigeria, where you see that some parts of Nigeria, they experience stability, and some parts of Nigeria, they're also negatively affected by the issue of terrorism, where there's the Boko Haram and all those other terrorist organization as well. So which means that they now have to take into account to say how much is our political risk exposure when it comes to our investment, because they know that anytime they can end up being affected by the terrorist activities, where some of their infrastructure can actually be bombarded, and they will end up losing the value of their infrastructure there, which will result in huge losses and huge losses for the multinational corporation. And remember, which means that when they lose that infrastructure, it means that the value of the multinational corporation is also going to be negatively affected. So which means that they have to take into account the exposure to political risk. So that's why you see that for multinational corporations as well, they ended up even moving out of countries like, for example, Zimbabwe, where they knew that because of the attitude of the government that they are investing in there, anytime the government can end up or can wake up one day and say we are going to be taking away 51% ownership in your operations as well. And that way, it basically means that the corporation would end up losing 51% of the value of the company there, which means that the owners, the existing shareholders, they will end up losing 51% of the whatever amount of money that they would have invested there. So which means that this is high political exposure. And because of this is why you see that, for example, in countries like Zim, a lot of multinational corporations ended up moving away from doing operations in those countries, mainly because the political risk would be deemed to be too high as well. So these are some of the risk exposures that multinational corporations have to take into account before they consider investing in a particular country as well. Are there any questions when it comes to these exposures before we go on to the overview? So looking at the overview of multinational companies' cash flows, they say most multinational corporations have some local business similar to other purely domestic firms. So because of the multinational corporations' international operations, however, their cash flow streams differ from those of purely domestic firms. So they give us the different exhibits which show the domestic firms and also multinational company as well. So here they say on exhibit 1.4, they give us the cash flow diagrams of a UK multinational corporation. And for the first one, they give us the multinational corporation focused on international trade. Remember we said with international trade, this is the basic import and exporting activities there, right? So what do we see with the basic importing and exporting activities there? They are going to be receiving, when they receive there's going to be payments received for products when they do exporting, or when they export the products there, they are going to be receiving they're going to be receiving payments from their customers. Then they also make payments to suppliers when they import the products, and they receive payments when they export the products there as well, right? Then they also payments received for exports, and then there's also payments made for imports as well. So which means that there's going to be payments when it comes to movements of products between the company itself and its and its other operations in other countries, where they're going to be doing the importing and exporting of the goods there as well. Then this becomes a bit more wider when it comes to the second diagram, where you look at the multinational company focused on international trade and international arrangements. So which means that now the multinational companies now, instead of just doing the basic import and exports of goods, they are also involved in other international arrangements, where, for example, they are establishing operations, establishing subsidiaries there as well. So which means in this case, there is going to be payments received for the products that they sell. Then there's also payments made for suppliers that they receive. And then there's also payments received for the exports. And then there's also payments made for the imports as well. And then when it comes to other international arrangements there, this is where there's going to be fees received for services provided. And then there's going to be expenditure resulting from services provided there as well. Which means that this is where there is now going to be the trade of not only goods, but going to be trading of goods and services. So when there's a trading of goods and services there, this is basically the second diagram that we're going to be looking at there. Then the activities also expand, where on diagram C, where they say the multinational corporation focused on international trade, international arrangements, and direct foreign investments. So in this case, this is where we are saying that with international trade, this is where there's going to be payments received for products, payments made for supplies, payments received for exports, and then the payments made for imports as well. And then when there's international arrangement, the international arrangements now is where they are going to be. This is where the import and export of services. And in this case, there's going to be fees received for the service provided, and then there's going to be expenditure resulting from services provided by the foreign company as well. Then they also do look at direct foreign investment, and this is where there's going to be funds remitted back to the parent company where they established the subsidiary, and then there's going to be funds invested in foreign subsidiaries as well. So this is where the activities of the multinational company are going to be more broader than the initial diagram that we see there. So are there any questions when it comes to these three diagrams?
Hi, sir. Yes, I have a question. Will they go as far as asking you in the exam to explain the cash flows to this extent, or is this more just for illustrative purposes to understand it better?
This is just for illustrative purposes for you to understand it better, because how they would ask you this question in the exam, it would come as like a cash flow diagram, where you see that later on in the chapters, you are now going to be prepared looking at the managing economic exposure and translation exposure for your multinational company. This is more or less how they would ask you, where you are now going to be doing the calculation to say, at the end of the day, how much is the net cash inflow or net cash outflow they're expecting of in each year that they're going to be doing operations as well. So it's not necessarily going to be coming out like this, but this is forming the basis for you to understand exactly how you now understand how the economic exposure and the economic and the translation exposures that the multinational company is going to be experiencing when you look at preparation of the financial flows. Like, for example, we are now trying to find out exactly how much is the net operating cash flow that they're going to be generating when it comes to its own local operations and foreign operations as well. So, but for you to be able to know how to do those calculations there, you need to know exactly where these calculations are coming from when it comes to movements in cash flows, and why there is such movements in cash flows as well. So the movements in the cash flows are basically going to be coming from these international trading activities. Are we on the same page?
Yeah, makes sense. Thank you.
Yeah. So don't worry about expecting to be asked to say draw this diagram and explain these movements in the cash flows. I don't think that they would ask you the question in this manner, but how they would ask you the question is for you to now be able to do the calculation of the operating cash flows, and how the calculation of the operating cash flows, the movements in cash flows are going to be based on these activities. Any other questions? Let's look at valuation model for a multinational corporation. And when you look at the valuation model for a domestic, when you look at the domestic model, they are basically saying that the value of a domestic company is given as the present value of expected future cash flows. So this definition, there's nothing complicated about this. It's going back to the same principle that you learned when you were doing your undergrad. So it goes back to the same principle that you did when you're doing your undergrad, where you were saying remember we said the goal of the firm is to maximize shareholders' wealth. And how do you maximize shareholders' wealth? By maximizing what? The value of the firm, right? So now, how do you get the value of the firm? How you value a firm is that you're going to be saying, for example, if your operations are expected to be for a period of 3 years, remember we're going to be saying it's going to be let's say, for example, you want to operate over a period of 3 years. It would mean when you want to find the value of the firm, you're not going to say how much is the cash flow expecting to generate in year 1, how much is the cash flow expecting to generate in year 2, and how much is the cash flow expecting to generate in year 3. Then you're not going to say the value of the firm is you're going to be discounting these future cash flows back to present value. So this is where you are going to be saying the value of the company today is the present value of expected future cash flows. So the value of the company today is the present value of the future cash flows, which means that the future cash flows are the cash. You are not going to be discounting these future cash flows back to present value, so that you're able to find the value of the firm. And remember, you're going to be discounting these future cash flows at a certain discount rate. And where this is now going to be coming from is where you're going to be saying how you find the value of the company. You're discounting these future cash flows. We are now going to be saying the present value is given as the future value over 1 plus R to the power of T. So which means the future value in this instance, the future value is going to be these future cash flows. So it's basically discounting these future cash flows back to present value. And this is how you're now going to be able to find what? The value of the company. So this is where that formula there's nothing complicated about that formula. You're just discounting future cash flows back to present value, so that you're able to find the value of the company there. So when it comes to a domestic company or a domestic firm, the same definition that you did when you're doing your undergrad is basically the same structure that you're looking at there. So there's nothing complicated there. Any questions? So looking at this, So looking at this, this is where we are saying the two major factors in valuing a multinational corporation are therefore returns as measured by the expected cash flows and risk is included in the discount rate. Then now, which means that when you're now looking at valuing international cash flows, there are certain factors that you have to take into account as well. And when you look at valuing international cash flows, they say, unlike their domestic equivalents, multinational corporations engage in projects with a wider range of risk. So even where the product is relatively homogeneous, which is basically the same, markets in different economies will differ more than in the same economy, and where relevant, the value of the foreign currencies are often will affect revenues and costs. So it is important, therefore, to distinguish between project discount rates and overall company discount rates. They will not be the same. So projects must be discounted using the risk premium relevant to the project and must not be discounted using the average rate or average cost of capital, irrespective of the project. Then if you go on to line number 8, they say the level of borrowing of a company should not affect the acceptance or rejection of a project. So as Modigliani and Miller showed, shareholders can adjust their investments to affect to effectively choose their own level of gearing, so it can hardly play a part in valuation. So a minor exception to this picture are tax savings from the borrowing. These affect the level of cash flows to shareholders and may make a moderate degree of borrowing more profitable for multinational corporations. So the independence of the shareholder risk preferences from the risk of the projects undertaken by the multinational corporation is known as a separation theorem. So it means that directors do not have to ask the shareholders whether or not the project is too risky for them. They simply have to value each project according to the market risk and keep the stock market informed of any significant changes to the multinational corporation's overall risk. So here they're basically saying that when it comes to the decision on exactly how to whether to accept or reject a particular investment, the decision on whether to accept or reject a particular investment is basically based on the comparison between the rate of return and the cost of capital. So as long as the cost of capital is more than as long as the rate of return is more than the cost of capital, it means that the project is going to be acceptable. Like, for example, if you're going to be using the internal rate of return when you did that you used when you're doing your undergrad, when it comes to capital budgeting, or when you were using the net present value method as well, that basically go based on the concept where you're going to be saying that the acceptance or rejection of a project is basically based on the principle where the internal rate of return has to be more than what? The cost of capital, which means that the choice of exactly the level of debt of the financing, when you look at the Modigliani and Miller, they are basically saying that there is no they are not necessarily going to be affecting your financing decision, mainly because what there is they can choose their own level of gearing depending on exactly what is the sweet point that they're able to actually able to see exactly how much where the cost of capital is going to be at their lowest level and the value of the firm is going to be at their maximum level. So which means that whenever, so the choice of exactly how much to the level of borrowing is going to be dependent on exactly is going to be different from one company to another company, because remember, it's going to be depending on exactly what the cost of capital of that company is going to be is going to be as well. Then, which means that in this case, it means that the directors do not have to ask the shareholders whether or not the project is too risky for them, which means that the directors of the company are the ones who are now going to be deciding on exactly which projects should be accepted and which projects should be rejected. And how they make that decision goes back to your capital budgeting decisions, where you say, when you look at capital budgeting, you have to look at what, for example, the net present value method or the internal rate of return method as well. And as long as the rate of return is more than the cost of capital, it would mean what? The project would be acceptable, because it means they are able to this is the point where the value of the firm is going to be maximized. And as long as the value of the firm is maximized, they don't necessarily need to be seeking permission from the shareholders, because as long as they are able to maximize the value of the firm, the shareholders are expected to be to be happy with the decision that the management will end up making as well. So because of this, if you check on the next paragraph, on line number 3, they say, thus the expected home currency cash flows to be received at the end of period T are equal to the sum of the product of cash flows denominated in each currency times the expected exchange rate at which the currency could be converted into pounds by the multinational corporation at the end of each period. So which means that the expected cash flow is going to be given as the expected cash flow during that period multiplied by the expected exchange rate. So which means that the expected cash flow is going to be affected by the expected exchange rate. Then after that, that's when you're now going to be now saying that once you find exactly what the expected cash flow is going to be, that's when you're now going to be saying that to find the value of the firm, you're now going to be now determining exactly how much the expected cash flow is going to be in your domestic currency, then you discount it back to present value. So what this basically means, what they're trying to explain here is that remember we're saying that for a domestic firm, the cash flow is known or is easily known because there's no movement between currencies. But now, when it comes to a foreign subsidiary or foreign operations, it basically means that the cash flows are going to be in foreign currency, which means that these cash flows have to be multiplied by a certain exchange rate that you have to estimate for year 1, and a certain exchange rate that are going to be estimating for year 2, and then a certain exchange rate that are going to be estimating for year 3. So this will now give you to see exactly how much the equivalent domestic cash flow is going to be. So this will give you this will give us the equivalent amount. So which means that this cash flow is in foreign currency. So this cash flow for year 1 is basically in foreign currency. So this cash flow is in foreign currency. So we have to multiply it by the exchange rate so that we first see exactly how much the equivalent cash flow in domestic currency is going to be. So we are going to be now finding out exactly how much the expected cash flow in domestic currency is going to be for each of these periods. Now, after we convert these cash flows into an equivalent domestic cash flow, that's when we can now be able to convert and discount the equivalent domestic cash flows back to present values. And now we are going to be able to find out exactly what the value of the firm is. So which means that for a multinational corporation, it's going to be a bit more complex because you have to now multiply each cash flow in each period by the estimated exchange rate. And it becomes very, very complex because estimating these exchange rates is a bit more difficult. It's a bit more difficult to estimate the exchanges because you don't know what the exchange rate is going to be 1 year from now. You don't know what the exchange rate is going to be 2 years from now. And you don't know what the exchange rate is going to be 3 years from now. So because of this, it basically means that there is a lot more risk involved when it comes to capital budgeting for multinational company to say, should we accept this project or not accept this project? Because any deviation between the estimated exchange rate and the actual exchange rate can end up affecting the accept or reject decision of a project. Why? Because if there's a deviation between the estimation of the exchange rate, the estimated exchange rate, and the actual exchange rate, if there's if there's going to be a significant deviation there, it will end up significantly affecting what? The accept or reject decision there. So this is where capital budgeting becomes a bit more complex for a multinational company than what? A domestic company there. Are we on the same page? Any questions?
Hi, sir. I just noticed that my textbook looks much different to yours. I thought it wouldn't be necessary to access the digital form of the textbook. Can you just remind us where you'll be sharing that?
What I'll do is that I'll send you guys the link. I'll send you the link for you to be able to access this.
Thank you.
In your textbook, how are they explaining this concept?
They aren't explaining it at all. They only refer to the different forms of valuation, and the only formula they provide is it's one formula. They don't break it down like yours did or does.
All right. So it's slightly different, but you need to, because remember, at the end of the day, you need to know exactly where the movements in exchange is going to be, because there's concepts that are going to be looking at, even when you look at multinational capital budgeting concepts that are going to be covering later on, and even when you look at the chapters that are going to be looking at, when you look at translation exposures and the economic exposures for a multinational company as well, the effects of the exchange rates is going to be very, very important, because it ends up affecting the acceptability of a particular project. So you always have to make sure that you bear that in mind as well. So there is slight differences there, but at the end of the day, you need to know this, that it's very important for you to know exactly what the effect is going to be on the estimated exchange rates, because the differences in estimated exchange rates there is going to end up affecting what? The acceptability of the project. So always make sure that you bear that in mind as well. So I'll also share with you my textbook, but the concepts are basically the same, although sometimes they differ a little bit when it comes to the explanations of the relevant concepts there as well. On the next section, they look at the impact of financial management and international conditions on value. And here they say, multinational corporations recognize that they may increase their value by increasing their cash flows or by reducing their cost of capital. Hence, their challenge is to make decisions that will accomplish one or both of these objectives. So a multinational corporation's financial decisions include how much business to conduct in each country and how much financing to obtain in each currency. So its financial decisions determine its exposure to the international environment. So here, when it comes to impact of financial management, international conditions are on value, you see that, remember we say when it goes back to your accounting equation, your assets is equal to equity plus liabilities. So your assets is equal to equity plus liabilities. And the asset here, this is how you determine, so the value of the firm is basically the value of the assets of the business. Now, when it comes to this, so this is where the choice of exactly how are we going to be now locating, how much are we going to be, how much assets are we going to be investing in each subsidiary. This is basically where you're not going to be determining how much the assets are going to be invested in each subsidiary. So this is where you look at investment decisions. So this is where the investment decision comes in. So this is where you make your investment decision to say, how much of the assets are we investing in country A, in country B, in country C as well. Then the choice of equity and liabilities. And remember, when you look at equity and liabilities, this is where you're looking at your ordinary shares, you're looking at your retained earnings, And then you're also looking at preference shares, because remember they are hybrid between equity and liabilities. And when it comes to your liabilities, this is where, for example, you're looking at consideration of the loans, and you're also looking at what? Issue of what? Of bonds. So this is where the financing decision comes in. So the financing decision comes in where you are now going to be saying how to finance these assets that we want to invest in different subsidiaries across the world. When you look at it for a multinational company, you're now going to be asking yourself, how are we going to be financing them? Are we going to ask the owners of the business to finance it themselves? Or are we going to be getting loans and bonds? Or are we going to be getting loans? Or are we going to be getting bonds as well? And even when it comes to this as well, you're not going to be having an issue or a decision where you're not going to be deciding to say, are we going to be issuing these loans or bonds from the domestic or from the foreign sources? So are we going to be getting these loans from the domestic financial institutions or from the foreign financial institutions? Or are we going to be issuing these bonds and only making them available to the domestic economy? Or are we going to be issuing what? International bonds as well? So this is where you're now going to be making what? Financing decisions. So which means a multinational company or a corporation, it becomes more complex when it comes to the investment decisions and the financing decisions, mainly because there is more complexity involved when it comes to the allocation of the assets, and there's more complexity involved when it comes to the financing decisions as well, where you're saying, are we financing with equity, are we financing with liabilities? And even when it comes to financing with liabilities as well, how much, where are we going to be, what are going to be our sources of loans and bonds that are going to be what? Utilizing for the liabilities? Are we going to be getting it from the domestic sources, or are we going to be getting that one from what? Foreign sources as well? So which means that when it comes to investment and financing decisions for multinational corporations, it's a bit more complex, mainly because there are so many things that needs to be taken into account by the financial manager as well. So are we on the same page when it comes to investment and financing decisions then? All right, so this means, so on the last section of the chapter, is basically giving us a breakdown of the organization of the textbook, where on that exhibit, they are basically saying that chapters 2 to 5 is going to be covering the background of international financial markets. And then chapter 6 to 8 is going to be looking at exchange rate behavior. And chapter 9 to 12 is also going to be looking at exchange rate risk management. Then chapter 13 to 16 of the textbook looks at long-term investment and financing decisions. And this is where you're now going to be looking at your decisions on exactly managing your translation exposure or economic exposure. Then chapter 17 and 19 looks at short-term investment and financing decisions. And all these are going to be now coming about for you to be able to know exactly how do you manage the risk and return of what? The risk and return relationship of the multinational corporation. And the reason why you want to manage the risk and return relationship of the multinational corporation is mainly because you want to be able to maximize what? The value of the multinational corporation through maximizing what? The share price of the multinational corporation. So this is how the textbook is structured. But please know that it's not everything that we're going to be doing from these chapters, because some of the sections are going to be coming. We're not necessarily going to be covering all the chapters here, because some of the chapters are covered under the what? Under additional readings as well that are going to be given. So this is the basic rundown and overview of what we're going to be covering when it comes to Fin4802. So this is where chapter 1 comes to an end. Are there any questions regarding what we did in chapter 1, or any other questions in general?
Hi, so I just quickly want to establish what the edition is that you are using of the textbook.
It's the second edition. Is the second edition. We don't have the latest, the electronic version of the latest edition as yet. So because of this, that's why you see that for demonstrative purposes, I use the second edition, but there's slight differences, but it's not that the difference is not that much or significant. So you see that where there's a bit of a difference, I'll highlight to say this is where the difference is, and I try as much as possible to put some notes in that edition so that you can see how the two editions link as well.
Okay, because something that they mention in either the 4th edition, which I didn't see at all, or you didn't mention, is they discuss the host country and MNC relationships, and it gives a bargaining model. I'm trying to get the name of the model, which I can't see now. And then they, under the MNC valuation, they pretty much just describe the 3 methods of how you can value a company or an MNC, which is stock market valuation and the accounts, and then financial academic models, and then they refer to the discounted cash flow model, which you obviously elaborated on now.
Yeah, I'm sure they do, but when it comes to the valuations as well, we're going to be looking at them in detail. I think it's going to be chapter 12, and which chapter is it? Where you look at the discounted cash flow method, like for example, the net present value. We are going to be looking at the valuations as well. So yeah, what I'll do is on the next class, I'll be having the textbook on hand as well, so that if there's any differences there, I'll just quickly highlight those concepts that are covered. But in most cases, the things that you've discussed so far, we are still going to be covering them in the later chapters anyways.
Okay, great.
Yeah, well, we are going to be definitely covering them, because you will see that when it comes to the valuations as well, we are going to be looking at them, because when it comes the concept, those concepts are going to be covered under capital budgeting, the different capital budgeting methods, and those capital budgeting methods are highly examinable. So we are definitely going to be covering them as we go in the curriculum as well.
Okay, great. And then there's self-test questions at the end of each chapter. Would you value them at all to go through them?
Yes, you can go through those self-test questions on your own, but what I'll usually more inclined to look at is that you see that the questions, how they present the questions in the textbook and how they usually present the questions in the if you check on the past papers, the textbook brings the questions a bit too simplified, because you see that as we go on with the chapters, they start merging up the different concepts that you would have learned at the beginning there. So yeah, go to the self-test questions. You can go to them on your own. If you have any questions or find any difficulties, don't hesitate to contact me and ask the questions as well, so that I can explain them. But usually because after a couple of chapters, I usually give out homework questions as well. So when I give out homework questions, I try to merge these concepts so that you're able to now look at them a bit more comprehensively than looking at the simplified questions which are asked at the end of each chapter. I try to merge them and give you homework questions which are a bit more complex and more comprehensive, because those are the type of questions that are going to be asked in the exam. The question that they usually ask at the end of the chapters, yeah, just know them so that you refresh you are able to refresh your understanding. But I will, at the end of the day, I'll still give you homework questions which are a bit more comprehensive than the simplified questions at the end of the chapters as well. So you can use them for practice purposes, but know that I'll still give you homework questions at the end of the day.
Okay, great. And then I think my last question is that you refer to, I read on one or two occasions that you refer to Blades PLC case study. Is that relevant at all?
Which case study?
I joined the subject last year and then cancelled it about a month later. So this is about a year ago that I read about the importance of blades PLC case study. It's on page 30 in my textbook. But I mean, if it doesn't ring a bell, I assume it's not applicable.
Okay, can you do this? Can you just take a picture, share it with me? Our address is in the next class because I need to have a look at it.
Okay.
I need to see, I can't remember which one you are referring to. Can you just take a picture and I'll address that your question in the next class? I need to have a look at it.
Okay, brilliant. Just on an admin note, did I speak to you this morning just before the class? Did you send me the link?
I think it's the other guy that you were chatting to. I don't remember.
Okay, how would
remember
your number then?
I think it's another person that you're chatting to.
Okay, how do I get your contact details then, or do you want me just to email it to you?
I'll share my email address. Okay. I'll share my email address. I think you're on the other group that I'm not directly managing. So I'll share my contact details there. Don't worry.
Okay, great.
Yeah.
Thank you.
I'll share my contact details just now.
That's it. Thank you very much.
All right. Thank you. Any other questions?
Muusha, for us to be more engaging with you in class, you're going to give us a timetable there to check which chapters to read or read on the following class.
Yeah, what I'll do is once you are able to once you are registered and you've created a link for you to be, because you are going to be you need to be having a user account. And on that user account, this is where you're able to get the material and also to get the videos of the next class as well. Because what we do is all our sessions from last year, they are also recorded. We record and edit the videos and make them available. So what we do is that after every class, we open up the video of the next class so that if you want to study in advance, you already know what the next video is going to be. And on that video, you'll be knowing exactly what is going to be covered in that class as well. But we always move in from one study unit to another study unit sequentially like that.
Okay, thank you.
All right.
Just a follow-up question. When you refer to a user account, are you referring to my UNISA account? Because I've
no, it's separate.
Yes.
So what we do is I'm going to send you on the other group as well. If you check on once you are registered, I'll send you a link, and on that link, it will ask you on our side to create a username and create your own password on our website. On our own website. So on our website, once you create a username and your password on our website, what will happen is that you are going to be having like a user account where all the updates, any videos that we do, any video that we upload, you will directly access them on the internet, on our website as well, directly.
Okay, great.
Yeah. But I'm going to send you guys the link so that you create your own user accounts as well. So you create your own password, you create your own user account, and what we do is that in the background, we now give all our authorization once you create that, so that you're able to access the material and the videos as well.
Thank you.
All right. Any other questions? So if there are no questions, this is where we're going to end today. I'm going to make sure that I send you the link with our timetable so that you know exactly when the next class is going to be. And remember, our classes are generally every second week for 3 hours. And but we also have to take into account if there's going to be any holidays and all those. We have to take them into account too, because usually what we notice that when there's a holiday, the turnout is quite low. So we try to take that into account when we prepare our timetable as well.